Yo, what's going on, everybody? It's Friday. Hey, listen, before I begin, I want to ask if you haven't already done it, please like and subscribe. It helps the channel tremendously. Many of you have been doing it, and I really appreciate it. The subscription numbers are going up, and that's great. So thank you very much. So right now, just take the opportunity to click like and subscribe, and I thank you for doing that. Let's talk about the market today. I've been saying this now for like the past week, that in an environment where economic growth is slowing down, like today was a typical kind of trading pattern where you had a strong open and then the rallies fade. Okay, this is exactly the opposite kind of trading dynamic you see at market bottoms when economic conditions are improving. They may not be obvious to many people, but when underlying economic conditions are improving, let's say after a recession or something like that, and the market had gone through a period of heavy selling and it came down by a fairly large amount, the selling during the day usually doesn't last and it bounces back. It doesn't start straight up. It takes time to form a bottom when the selling becomes exhausted. We're seeing this now, this pattern develop at the other side, on the top, when the economic growth is slowing. And I said this going back weeks already. I said that I was suspect about the rally. I said that the stock market is not reflecting the slowdown in economic growth. I've been giving you guys numbers where I said that we're going to have like 2% or less GDP, and that's coming down from 3.2% at the final quarter of 2023. And it may even be lower than that. I've been talking about the drop in net government transfers. Yesterday I said you should really see the graphics on this. If you haven't gone to my website, you may want to go there and sign up for a 30-day free trial. It's not going to cost you anything for 30 days to see these graphics. But it is, I wouldn't say it's enormous, but it's consequential. Yesterday, I explained that the decline in net government transfers on a monthly basis, it now totals about 20 billion a month. In other words, 20 billion a month that had been transferred into the economy is no longer getting transferred into the economy. Okay, that means the deficit is shrinking. And I mentioned that the interest income transfers from the discount on T-bills, that's running at about 25 billion a month. So the reduction in those net government transfers almost takes away all of the interest income transfers from the discount on T-bills. All right, and that has been a very significant channel of interest income transfers, that discount on T-bills. So it's not insignificant, and it is causing the economy to slow down. And as I said yesterday, I don't think this is going to be a recessionary thing. I just think we're ratcheting down from a higher growth pace into a slower growth pace, something in the order of like maybe flat to up to 2%. I'm putting 2% as the upper end of GDP growth. It's still decent. And the stock market could still move up over time with a 2% GDP growth. There's no problem with that, but it has to adjust to the slowdown that's going on right now. And the trading action, like I said at the beginning of this video, is to me, it's very apparent that we're starting to feel it in the market. Remember, I always tell you that the market follows the economy, not the other way around. A lot of people think that it's kind of the tail that wags the dog type of thing, where the stock market leads the economy. No, the stock market reflects corporate profits, it reflects earnings, it reflects wages and salaries, and that is a function of economic growth. So when growth is slowing down, you're going to see those things start to come down. Corporate profits, they'll either come down or companies will issue lower guidance or weaker guidance, or in order to sustain profitability, they might initiate spending cuts, which could include job cuts. So you could see the unemployment rate rise a little bit. All these things, which right now they maybe are not evident, but we know growth is slowing down. And again, today was a classic day in trading action when you look at how it started out strong and then it faded. As a matter of fact, I sent out this morning, I said, I don't think this rally is going to last. It's the typical pattern where you're going to get a strong opening and it's not able to hold on to that. And as a matter of fact, today, here's what I said in my email, because today we had the PCE price, was it? Personal Consumption Expenditures Price Index. People call that the Fed's favorite index. I don't know if it is or if it isn't, but that everybody, it's the Fed's favorite index, the PCE price index. And that showed flat, zero price increase in May, and the core was up only 0.1%. Now, if this number had come out a month ago, or certainly 2 months ago, there would have been a gigantic rally in the stock market, because all the monetarists would have been jumping on this, cheering, yeah, that the Fed's going to cut interest rates because this is their favorite indicator, and it's showing zero price increases. But today it was like yawn. It went up. It hardly even moved when that PCE index came out. Then it popped up, and then it gave everything back and went into negative territory. So, I mean, that's another sign right there. If you want to look at market behavior and how it responds to news, that right there, you had a great example of it today. You had a fantastic example of it today. That was an indicator that should have made, as a matter of fact, that's what I said in my email. I said that was an indicator that a month ago, it would have triggered all the monetarists. They would have been falling all over themselves to buy the market. And I mean, it basically did nothing today. Did nothing. So there you have another sign. So I think this pattern is going to continue, and then we can get a big drop. I don't know how much in terms of percentage points. It depends how economic activity unfolds. All right. If I continue to see these net government transfers dropping, I think now they're going to stabilize. Look, we're in June, July. Oh, we got 4 more months of the fiscal year. I think we're going to stabilize. But I said that like a month and a half ago, and we've gotten worse. Okay. So if we drop further, I mean, there is a chance that economic growth could fall to zero, just flat. I don't think it's going to go negative, but I think it could get very close to zero. And under those conditions, like I've been saying, stocks are overvalued. I'm not predicting a bear market. I'm predicting a healthy correction. Sooner or later, if these rallies continue to fail like this, then some people are going to get the hint and they're going to start unloading, okay? Because I think there's a lot of people who came in late to this rally. I've been talking about this for 3 months, where I said, you had all these folks last year, these monetarists who were so bearish and negative because of the Fed interest rate hikes, and they stuck to their bearish guns, and the market kept going up, rising that wall of worry. It kept going up and up and up. And a lot of these people, since April, they flipped around. They said, now's the time you got to buy. Everything looks fantastic. Now you got to buy. A lot of those people came in late to the game, all right? And they came in at a time when economic growth was slowing down, and when the market had already, gone on a very significant rally to, many new highs, one after another. So a lot of that's going to get corrected, I believe. Anyway, it's Friday, folks. I just wanted to put this out there. And once again, Please like and subscribe and have a great weekend. I'll see you on Monday. Bye.